Hi there, and welcome to another in our series of economics revision webinars focusing on the new A-level syllabuses and in particular gearing up towards the summer 2017 exams. This is our webinar on commercial banks and the UK economy. And as is customary with our webinar series, we'd like to get you involved. We're going to start with a quick quiz. So question 1 for you. Which one of the following is Britain's biggest commercial bank as measured by the total size of assets under their control? I'll be back in a few seconds with the answer. And the answer to this question is Lloyds Banking Group. Easily Britain's biggest bank, not just in terms of assets, but also in terms of market share and the number of branches, for example. Question number 2. Which one of the following was the first organic entrant into the UK banking market in more than 100 years when it received its banking licence in March 2010? Press the pause button, have a go, I'll be back in a few seconds. And the correct answer to question 2 is Metro Bank. Of course, we've seen the rise of other banks, including Marks and Spencer's and Tesco, but Metro was the first to get the first organic entrant into the market, receiving its own banking licence. Question number 3. During the financial crisis, the UK government took large holdings in several UK banks to restore financial stability. Which one of the banks listed below has not had any emergency financial support from the UK government? And the answer to question 3 is Barclays Bank. All the others have, including Royal Bank of Scotland, which of course remains largely state-owned. Question 4. In 2014, what percentage of our GDP came from the output of financial and insurance services? Was it 8%, 18%, 28%, or 38%? Press the pause button, I'll be back in a few seconds. And the answer to this question is 8%. Perhaps surprisingly, of course, the financial service sector is much bigger in terms of other business and financial services, but financial insurance, 8%. Let me show you a few logos here, and for each one, press the pause button, give yourselves a few seconds, see if you can identify 7 bank logos. I can guarantee, folks, you will not get all 7 right, but let's see how many you can get. Here's logo 1. And that bank is HSBC. Here's logo 2. Which bank is this logo? The correct answer is Lloyds Group. Here's logo 3. And that is the logo for Barclays. Did you get 3 out of 3? If you did, those were the easy ones. Here are 3 harder ones. Here we go. Here is logo 4. Which bank is that? You've got the right answer. The answer is Santander. Here's logo 5. What bank is that one? Now in our live webinar, this is where people start getting confusing answers. The answer to this one is ING, Dutch bank. And which bank is logo 6? Logo 6 belongs to Deutsche Bank. So if you got 6 out of 6, you have my total undying respect, top effort. Have a go at logo number 7. Which bank has this logo? I'm going to crack on with this because I've got a feeling you probably don't know the answer. If you said the Bank of Outer Mongolia, you'd be wrong. It's the Bank of Inner Mongolia. So there we go, quick quiz. Let's go on with some economics. So we're going to look at aspects of commercial banking in the UK economy and start off by thinking a little bit about why banking is important. The banking sector, of course, has come under lots of criticism in recent years. There's been the fallout from the financial crisis, all kinds of debate and discussion about the role of finance generally in our economy. But I think it's fair to say that commercial banks are important There are means by which credit can be supplied for expanding businesses, both small, medium-sized enterprises, perhaps a startup, ranging through to the bigger corporations. Banks, of course, commercial banks provide a full range of financial services for households, ranging from safe treatment of deposits through to managing cash flow, all kinds of different services you can get, currency exchange, etc. Crucially, I think when the commercial banking system is working well, when there is a degree of financial stability, that generates lots of positive externalities. People have more confidence in the system, people are more willing to invest, the economy functions more efficiently. Turn it on its head, and of course, when there's financial instability, all kinds of issues and negative externalities can result. Commercial banking sector is important for trade, not just in terms of selling banking services to other businesses in other countries, but also, for example, as a means of providing trade credit to companies and businesses that are looking to export goods and services overseas. We know that many thousands of people are employed in banking, and crucially, the commercial banking sector is by and large the way in which monetary policy feeds its way through to the economy. When the Bank of England signals a base rate change, it's through the banking system by and large that those interest rate changes feed through. So there's no question that commercial banks are significant. The market itself in the UK is best described as an oligopoly. Notice here the top 5 firms, if you look at percentage of total current accounts, savings accounts, top 5 firms accounting for a sizable percentage of the market. Lloyds out ahead, Barclays, Royal Bank of Scotland, HSBC, followed by Santander. The Nationwide is Britain's biggest building society. And it's an oligopoly where it's pretty hard for new entrants to come in and make a profit. People are trying, businesses are trying to enter the market. In recent years, we have seen the emergence of so-called challenger banks. These are new kids on the block, new banks looking to try to establish themselves, first of all, and then perhaps chip away at the dominance of the main UK commercial banks. Virgin Money, for example, bought the assets of Northern Rock. Some specialist lenders, Aldermore, Handelsbank and Shawbrook. And it's Metro Bank, which has been probably the most high-profile bank coming into the UK in recent times. But it's difficult. It's pretty hard for the new banks to enter the market profitably. This is what allows us to revise the concept of barriers to entry. We know that in an oligopoly, the entry barriers can be quite significant. And that allows the existing players to continue to dominate the market. What are some of those entry barriers? Well, first of all, there's the significant fixed costs of setting up the complex IT systems and the branch networks that you need to be a big player. You need to have access to the nationwide and international payment systems, and that can be quite expensive. Established banks, of course, have got their foot in the door. They've already built up networks and they've built up a loyal band of savers who are willing to deposit money with them. For example, I've been with the Yorkshire Bank since birth, and I've been with Lloyds Bank since I was a teenager, and I've no real incentive to change. That's where my money goes for my job. Bigger banks typically are seen as lower risk, and therefore when they go to the wholesale money markets for funding, they can often borrow money more cheaply than a new bank can. So we call that an economy of scale. I think point 5 is quite significant. There's a kind of underlying behavioural reason why new banks find it tough to break into their market. There is quite a lot of consumer resistance to changing accounts. In any given year, only about 3, possibly 4% of us actually change our bank accounts. It's costly, it's inconvenient, it's a bit of a hassle, and it does make it harder to build the scalable numbers of customers you need to make money. Let's move on a little bit to think about how banks do make money in the system. Here's a question for you. Again, press the pause button and have a think about the answer. True or false? The main source of funds used by commercial banks to lend out to borrowers are the savings deposits of individual households and businesses. True or false? And the answer to this question is true, as we'll see in a few minutes. That's true. Next question. Banks first attract deposits from people, and then then they lend it out to customers who need to borrow money. True or false? And the answer to that question is false. It's a little bit of a misconception that people often talk that in order to lend out, banks need to attract deposits. No, they don't. And again, as we'll see in a second. The old style theory of banking was that banks take the deposits of money from us, from savers, from individuals and businesses. They take the savings, keep a little bit away in cash, and then lend it out to people who need to borrow money. And thus they allocate funds between alternative investment projects. The reality is actually different. I think it's really quite important to emphasise that how does a bank create money? It creates money by creating credit. How does a bank create credit? By creating loans. Pure and simple. Okay? They don't need to attract deposits from savers to do that. People go to the bank asking for a loan, a mortgage perhaps, maybe an overdraft to help their business, or maybe a loan to invest in something. The bank does hopefully a credit assessment, credit risk assessment, and then decides, yeah, we'll lend you £10,000. That £10,000 is credited to your bank account with a bank deposit of the same size of the loan. As soon as the bank creates the loan, creates the deposit for you to spend, money is created. As the Bank of England says here, banks making loans, customers repaying them, are the most significant way in which bank deposits are created and destroyed. So it's the net creation of deposits from the banking system that really matters. Typically a bank has both assets and liabilities because it has to have a balance sheet. So the assets are essentially owed to the bank, in other words, the bank counts it as an asset. Cash in the bank, for example, commercial balances at the Bank of England, the loans it's created. And typically banks will also invest not just in loans, they'll also invest in bonds, perhaps some shares, they'll invest in property, they'll have some fixed assets. So banks will arrange their assets, they'll have some liquid assets such as cash, and they'll have some slightly less liquid assets, which one would categorise, for example, as buildings that banks own. And on the liabilities side, the main source of the liabilities are the deposits, which you and I put in the bank, because we can go back to the bank and ask for money back at certain points. It's quite interesting that people, all people hold cash. I mean, banks hold cash for sure. So do companies. I noticed this the other day that PayPal has $13 billion of cash in its account. American Express has $3 billion of cash. Starbucks has over $1 billion of cash. That's bigger than actually cash in the customer's bank. Partly because Starbucks makes profits, obviously builds a cash total, but also a lot of people buy a £20 Starbucks customer card. That allows them to buy their coffees in the future. Starbucks is thinking, thank you very much, put £20 on the card, we'll have the cash. Yes, we've got to produce some coffee in the future, but actually we'd rather have the cash, thank you very much indeed. A lot of people, of course, don't use their cards up fully. The key thing, though, is that when a bank lends money out, so you go to the bank and ask for, let's say, a £10,000 loan, all that does, if the bank says yes, is it adds to assets and liabilities. So on the right-hand side here, a bank's created a new loan, it's an asset, and there's also a new deposit, it's liability. So the bank's balance sheet expands as the bank is lending out. Now, where do the banks get the money from? Well, yes, they do rely on retail funding. So it's important for the bank to attract savings deposits, don't get me wrong. But the banks can also raise money from the wholesale market. They can go to the money market and borrow from other banks if they want. They can raise fresh capital. They can sell some shares to raise equity if they want to increase their funding. But typically banks rely heavily on retail funding for their accounts. Very simple question coming up. How do commercial banks make a profit? In simple terms, please tell me how a bank makes a profit. Well, it's simple really. The interest they charge on the savings, shown here in yellow, a sight deposit is money that can be taken out of your account immediately with no loss of interest. Not that you lose much interest. A time deposit is money that's held on account, savings account, so maybe there's a limit to how much you can take out or you have to give 7 days notice. But you can see that the rates of interest on savings accounts are pretty low, And the bank charges more for the loans, credit cards, average 10%, unsecured loan without any assets backing the loan, 6.5%, 7%, secured loans where there's some collateral behind the loan, about 3%. Well, the blue bits are higher than the yellow bits. So in other words, the bank makes money by charging a higher interest rate on loans than it does on deposits. However, profits are not guaranteed, as we've seen in recent times. A lot of banks have made big losses. In fact, the profitability of the banking sector has fallen quite a bit since 2007, 2008, the start of the global financial crisis. And this profitability is an issue for the banking system going forward, because it means they're a little bit more fragile when it comes to their ability to absorb losses in the future. Why are bank profits down on 10 years ago? Well, first of all, there's been a significant increase in regulatory costs. Post-crisis, the regulatory system has tightened up significantly. There's been a cut in interest rates. The rate of interest on mortgages, for example, has come down quite sharply. But for the banking system as a whole, the biggest single negative for profits has been the penalties the banks have had to meet for previous unacceptable, unethical behaviour, in particular the mis-selling of payment protection insurance. Billions of pounds have had to be set aside for that. And along with some of the bad debts from some of the dodgy loans before the crisis, a lot of banks have suffered a lot. Here's a good example: the Royal Bank of Scotland reporting a loss of nearly £500 million in the 3 months to September 2016. It actually made an operating profit, day in, day out operating profit of 1.3 billion, but it had to put aside so much for litigation, restructuring of the bank under state ownership and that kind of stuff, that it turns out it still makes a loss at the end. The Co-op Bank, its losses in 2015 doubled to £610 million. How does a bank lose 10 million quid a week? Well, conduct and legal risk charges, 4 million quid a week, higher provisions for mis-selling of PPI, and crucially, they're having to write off some of their property loans which have gone bad, creating a big hole in their finances. So bank profits come under a lot of pressure recently, partly because of the squeeze on interest rates, but also because of the misbehaviour of the banks themselves. This goes back to the subprime crisis. We're going to do a special webinar on the big subprime lending crisis, but have a look at the mortgage delinquency rates in the United States from 2000 through to 2014. The delinquency rates are when people fall so far behind with their mortgage that effectively they default on their loans, at least 90 days behind. By 2008, 20% of people were at least 3 months behind on mortgages. By 2010, it was over a quarter. It remains extremely high now. So, this has been a huge drain on bank profits. They were selling subprime mortgages and charging high interest rates and making big sums when the housing market was booming. But now, 25% loan delinquency rate, big loan default rates. Of course, a lot of banks have gone bust as a result because of their greed in many ways. And this leads us on to the whole question of financial instability. When the commercial bank system works well, I think it's a positive public good for an economy. It's an important source of revenue and jobs and tax revenues. But when the system fails, the externalities, the social costs of financial instability are significant. As taxpayers, we bear the cost of bailouts. If we decide banks are too big to fail, depositors are at risk of losing their savings. Creditors, people who are owed money, may not get paid. Shareholders lose out if bank share prices collapse, although they've taken the risk anyway. Employees lose their jobs. And of course, the government not just loses the tax revenue from the banks, but also maybe the fiscal cost of bailing them out. So financial instability can be a really crucial issue. But we'll do a special webinar on that a bit later on, closer to the exam. Here's a final question for you in tonight's webinar. What's the most important factor, you think, limiting the amount of new credit that a commercial bank is able to lend? Let me go through these answers with you. What's the most important factor limiting the amount of new credit that a commercial bank is able to lend? Is it the ratio of cash to deposits that the bank is required to keep by law? Is it the demand for loans from personal and business customers? Is it caps on interest rates on loans and overdrafts set by the Bank of England? Or is it D, the cost of borrowing funds from the wholesale money markets? What's the most important factor? Limiting the amount of new credit. Have a think. Press the pause button, we'll be back in a few seconds. And the correct answer is B. Quite important. In fact, A is not really right. The banking system, there are some liquidity requirements. Banks are required to maintain sufficient liquidity, but the Bank of England does not set high ratios of cash to loans. Just doesn't do it. That's not the system we have. C is wrong because the Bank of England doesn't actually doesn't cap interest rates on loans and overdrafts set by commercial banks. There is a cap on the interest rates set by the payday lenders imposed on businesses like Wonga by the Financial Conduct Authority, but that's not the same thing. D is a good answer. Clearly bank profits are affected by how much it costs them to borrow money from the wholesale money markets. Keep in mind that most of the money that the banks get, which they lend out, comes from attracting retail deposits from you and I at businesses such as Starbucks and Tesco. No, in fact, B is the right answer. The main factor limiting the supply of new credit in the UK system is in fact the demand for loans and overdrafts and other forms of credit from personal and business customers. And ultimately, the demand is affected by interest rates, it's affected by confidence of consumers and businesses, and it's affected by the strength or weakness of the economy. So it's B. We always leave a few definitions for you to think about if you want to write a few definitions down as part of our webinar. So here are some sort of key banking definitions. But actually there's a load more, a shed load of financial definitions in our new definitions booklet, which is available from the website. Great little resource that. And of course all of our other videos are available online. We make all of our webinars online on the YouTube channel, and there are hundreds of short 1 to 5 minute videos on different economics topics. So please take a look at my YouTube channel or contact me on Twitter. I'm at TutorTuteJeff, and I'll be happy to help with revision if I can. Thank you very much indeed for joining in this revision webinar on the UK banking sector. Take care and see you soon.